Hey traders, hope you're having a fantastic day. This is Bing from BCR with today's market analysis. Alright, jumping right into the Aussie dollar, we can see that the Aussie rebounded from its year-to-date lows with its negative bias intact. Investors are cautious about shorting the dollar as the US dollar data is released. The RBA softened its US hawkish tone and increased pressure on the Australian dollar. The AUD/USD lingered on Wednesday after falling in the previous session. AUD/USD faces challenges driven by the overall strength of the US dollar, and the CME FedWatch tool shows that the traders are currently pricing in a nearly 85.8% probability of a 25 basis rate cut by the Federal Reserve on December 18th. The Australian dollar came under pressure after the RBA decided to keep the official cash rate at 4.35% at its last policy meeting in December. RBA governor stressed that although the upside inflation risk has decreased, the risk still exists. Hence, the RBA will closely monitor all economic data, including employment data, to guide future policies. For a technical point of view, the analysis of the AUD/USD traded around 0.637 in the middle of the week. However, the Aussie dollar fell into the downward channel pattern and the bearish momentum increased. Furthermore, the 14-day relative strength index of the technical indicator is slightly above 35, indicating that the bearish tendency is maintained. The recent support level is around 0.6348, and the low of the year, which is the low of the year on August 5. If it falls below this level, the bearish bias will increase, and the Aussie dollar currency pair will face downward pressure and will sail around the psychological level of 0.63. However, on the outside, the Aussie dollar pair may find initial resistance around 0.64, followed by the 9-day moving average of around 0.644, which coincides closely with the upper line of the descending channel. A clear breakout above this range could pave the way for a move to around the 0.65 level. Moving on to the dollar index, the dollar halved its earlier gains after inflation came in lower than expected in November. As mentioned previously, traders are betting on the Fed's last rate cut next week. The dollar index is currently trading around 106.5 and failing to rise. The dollar is at a new high in its recent rally as US Treasury yields rise and market caution is strong ahead of the release of US inflation data on Wednesday. The dollar index rose for the third consecutive day, continuing its momentum to break through the 106 mark ahead of the release of the key US inflation data. Currently, the US dollar index continues to stabilize. In the short term, the seasonal weakness of the US dollar in December and the fading impact of the political turmoil in the market are expected to continue to fluctuate in a narrow range. As for the medium term, the dollar's trend mainly depends on the policies of the new US administration, and it is estimated that the dollar still has room to strengthen against multiple currencies next year. The dollar index is trading near 106, and technical indicators on the daily chart provide mixed signals. The 14-day relative strength index is in positive territory, with a latest reading of 58, indicating that the bullish momentum continues. As for the MACD indicator, it shows smaller red histogram bars, indicating less bearish pressure. The US dollar index is approaching the 20-day simple moving average at 106.45, which is a key level for the short-term direction. Resistance is near 106.7, which is the last Wednesday's high, with further obstacles pointing to 107. While support remains strong between 106, further targets will point to 105.74, which represents the 34-day moving average, and 105.72, representing the daily chart descending triangle support line. Last but not least, let's dive into crude oil. Momentum has increased as oil prices rise due to rising tensions in the Middle East. OPEC will release its monthly report and no events are expected. The US dollar index surged on safe haven inflows as uncertainty over the Fed Reserve December rate decision increased. WTI crude oil traded near the $68 mark during the Asian session on Wednesday. WTI oil prices remain on the defensive amid the unexpected climb in crude oil inventories and a weak demand outlook, especially in China. However, escalating geopolitical tensions in the Middle East may prevent WTI oil prices from falling, but the increase in US crude oil inventories last week may weigh on crude oil prices. On the other hand, the Middle East region has seen increased unrest as Syrian President Bashar al-Assad and his family fled to Moscow and received political asylum last week, ending 50 years of brutal dictatorship. The continued geopolitical tensions in the Middle East may help limit losses. WTI crude oil prices found support near 66.8 to $67 after forming a triple bottom support area. consisting of November and December. The price faces resistance near $69.11, representing the 30-day EMA, and 69.22 at the 23.6% Fibonacci retracement from $77.93 to $66.53. Currently, the main resistance remains near $70, like the psychological level, and is $70.05 at the 50-day EMA, above which the price is likely to accelerate upward. In this case, the price can even test 71.15 and 72.55, which is the 38.2% and 50% of the Fibonacci retracement from 77.93 to 66.53 respectively. On the downside, the first major support is nearly 67.8. A close below 67.8 could result in a deeper decline, with the next major support is the November low of 66.61. Any more declines in the coming days could bring oil prices closer to the year's low of 64.75. All right, thank you for tuning in to today's market analysis, and good luck in your trading journey.